Joining us for a closer look at the quarter in a CNBC exclusive is First Horizon CEO Brian Jordan. Brian, how would you characterize the quarter now relative to earlier in the year when we were all worried about the health of regional banks?
Yeah, I think the quarter was an outstanding quarter. I'm really proud of what we were able to accomplish. I think the banking system has stabilized tremendously since the early months of this year, March, April, and May. I think the momentum in our economy is starting to slow down a bit. But overall, I think the banking system has reached a very strong and stable point, and I think confidence is building in that system and is likely to continue.
You actually saw some deposit growth at the end of in the quarter, and that goes against pretty much what the industry has been seeing, which is deposit flight in favor of higher yielding securities. What's driving that for you?
That's right. In the H8 data, deposits were roughly flat across the industry for the third quarter. Our deposits were up 1.5% or 2%. We had a great effort from our people to attract new-to-bank relationships. We picked up something like 19,000 new-to-bank relationships. And we've been very front-footed in trying to grow our business. We're very fortunate to do business in a great economy in the South. We have great markets, great economy, and our people are very front-footed and looking to grow our relationships and broaden and deepen over the long term.
But can we connect the dots between the higher deposit costs, which we did see jump? I mean, you're obviously paying up for these deposits, and I think more than just the jump in Fed funds rate. So is that what it's going to take to continue to grow?
Yeah, that's right. What you saw in our deposit costs this quarter is really the pull through from a campaign we ran in the back half of the second quarter. Our deposit costs in that campaign were significantly higher than the rates that we were booking deposits in the third quarter. So, for example, our blended cost in the third quarter was close to in the second quarter was close to 5%. The blended cost of deposits raised in the third quarter was 4.2%. So what showed up in our net interest margin was the pull through or the full quarter impact of the second quarter campaign. From here, we expect our net interest margin to actually start widening. We think deposit costs will start to trend down in the fourth quarter and into early 2024 and beyond.
That's sort of been that rhymes with a lot of the guidance we've gotten from some other financials in the last week or two, Brian. I wonder, everybody's asking about the credit environment and whether or not it remains in control. As you think about it, is it something that would turn on a dime if things did change?
We don't see any big significant changes. We highlighted earlier in September a idiosyncratic credit as it relates to us. Outside of that one large credit, our credit cost was very steady with the early part of this year. And as we look into the fourth quarter and into early next year, we're not seeing a tremendous level of deterioration anywhere in the portfolio. Clearly, you're going to see higher interest rates and a slowing economy, tightening credit conditions start to have some impact. But right now, it does not feel like credit is deteriorating at a very rapid rate and is likely to hold up for the rest of this year and in the early part of next year.